Welcome to Market Pulse by SC Securities and Daily FT. I am Dilusha Gamage representing SC Securities, and today I am in conversation with Mr. Dimantha Matthew, the Head of Research of First Capital. Dimantha, welcome to Market Pulse.
Thank you for inviting me.
Dimantha, to start off the conversation, now we are going through a challenging time, that's no doubt, and the investors are quite worried. So what is your view on the market, and also how would the investors should go forward from now onwards? Now today market is opening after 2 weeks. So what is the way forward for the investors from now on?
So basically I think the worry is understandable. It is primarily created because of the political uncertainty that is coming in on top of the economic shock that we have witnessed. So if you go through the periods of 2018 to 2020 also, we saw this political uncertainty continuously being there, and that has been a significant deterrent factor for the market to really move up. However, in this current situation, what we can expect is that there are things happening in the political front, and as an investor, what you should expect that assume that this quarter is like going to be like a bottom effect for the market. We may see the market sort of bottoming out during this quarter, and that will give you an idea how to plan ahead. So with that, this is not the first time we are going through this kind of economic shock and going into the IMF. So we've seen periods of 2001, 2008. We've always come out of these kind of shocks. Only thing is, this time the situation is more aggravated than what we've seen. But you can see on the monetary policy front also there is accelerated corrective action that is taking place. And so with it, if we start seeing some sort of positivity on the political front, and the monetary board and the central bank is doing what is necessary on the economic front to get the economy on the right track and to move into a IMF program. So as an investor, you need to have a long-term view. So next 3 months is going to be critical, and if you can wait or hold on to the next 3 months, have a strategy of accumulating more stocks. If you already have a portfolio, restructure your portfolio and move into more fundamentally sound or defensive counters, as we say it, or even average down on some of those defensive counters. That is the way forward over the next immediate short-term period.
Okay, Dimantha, in that case now, if an investor is accumulating, what are the recommendations from First Capital?
Yes. So if you look at a person who's starting to accumulate, first thing that you need to look at is dollar income companies. So you can see that the currency has significantly depreciated. Even currently we are seeing the overall market declining, and most of these dollar income companies are also coming down in value. But if you are looking at a recovery, the market, equity market is always a cycle. We've seen these cycles go through, and in the past decade we've seen about 3 cycles happening. So we have to look ahead at the next cycle now. What is going to be the counters that are fastest to recover? So definitely with sort of 80%, 100% gain in some of these dollar income companies without any productivity improvement, you are likely to have a significant benefit in these counters. So you need to move into, number one priority is to move into these dollar income companies. And then secondly, look at distressed assets. Most investors in these kind of economic shocks, especially high net worths, look at what kind of distress assets are out there for me to accumulate. Even retail investors can look in terms of the stock market, what are the distressed assets. I would say banks are a key priority if you're looking at distressed assets. So let's try and go into some of the key banking stocks, especially the for large banks are some things to look at, trading at less than half of their book values. Then what are the other companies that are going to benefit with higher interest rates? Life insurance companies are going to be key. Higher interest rates are going to reduce the valuation of their life portfolio, boosting profitability, and even the higher yielding government securities assets are going to increase their interest income in going forward. So these are some of the key areas you should be going into, and look at other companies that are also having dollar income. I would say power sector is something key to look at. You have a number of companies that are having more than 50% dollar income companies. So try moving into those strategic areas and look at preserving your portfolio, and also look at dividends out of these companies, because even if the market is moving down, you can benefit from the dividends, and you can even using those dividends average down. So that is a key benefit in these periods, and even in the previous downturns, something that we've seen is that high dividend yielding players are basically the market returns are reverse to the general market. When the overall market starts moving down, these high dividend yielding counters tend to move up. We've seen this significantly during the 2012 downturn. You've seen Chevron Lubricants, Ceylon Tobacco, such stocks reversing and moving up in a downward trending market.
Okay, and also Dimanta, now we have seen a steep drop in the market. So the margin sales or the broker credit and the forced selling was a major factor. And recently the stock exchange have come up with a kind of a solution, even though it's a short-term solution, to ease off this forced selling. So what is your view on that, and how will that impact the market from now onwards?
So my personal opinion is that broker credit easing is going to have actually a limited impact on the market, because if you look at most portfolios that is having credit has moved into this high level territories, 70%, 80%, 90%. So because of that situation, it's going to be very limited what this easing of broker credit can do, because with on the 8th where there was a very significant hike in policy rates, we are definitely likely to see a reaction in the market for that, coupled with the public unrest and the political deadlock. So all of that put together, we may see, we are likely to see some negativity on the market at the start of the market itself, especially during the first couple of days. It might be similar to a situation where we saw during the COVID period. After the market closure during May 2020, the market opened and we saw a couple of days significant deterioration in prices. So it could be somewhat similar to that, and then beyond that we immediately start seeing stability in the market. So with this situation also, though that easing is there, those limits are also likely to get easily breached when the market is falling at this kind of a pace. So because of that, what we feel is in order to resolve this, you need to keep the market open, and gradually you will see after a couple of days the market finding the place of stability on its own. And then from there on, if it's at oversold territory, then market there is likely to be a bounce back in the market as well.
So what is your final message or the advice to your investors watching this?
Yeah. So my final message is that of course there is going to be blood on the streets. Everybody knows that, and everybody is expecting that. But your approach should be not the same as the other investors. So be smart and look at your portfolio and try to adjust your portfolio rather than looking at the overall market per se. Yes, the overall market may move down, but there are specific stocks, value stocks that you can invest in. Because in a market where there is a lot of selling is where you can buy stocks at bargain prices. If the market turns immediately, such a small market like Sri Lanka, you're likely to have no selling pressure, no liquidity in the market to buy stocks. So be aware of that. Spread your buying. There's no reason to buy everything in one go. So spread your buying. Buy into the downtrend in a slow manner, and spread your buying over the current quarter and probably over the next 6 months, so that you can properly average out, because you cannot find a bottom of the market suddenly, because even at the top of the market in January, no real person caught the top. So either you sell before gradually sell out as we recommended, and similarly in this downtrend period you need to gradually buy into the market. So that is my final piece of advice.
That's a great advice, and thank you, Dimantha, thank you for joining with Market Pulse. And ladies and gentlemen, this is Dimantha Matthew, the head of research of First Capital, and with that, we are concluding for now, and thank you for joining with Market Pulse.
For more latest news, subscribe to FTTV.